Hey guys, so this is part 2 for chapter 10 notes. So just a follow up from the first part that I sent you guys last week. So like I said, we're focusing on amortization or depreciation, whatever you want to call it. Both mean the same thing. So for this portion of chapter 10, we're going to focus on ways of calculating amortization. So as a term itself, it's the process of allocating to expense the cost of a capital asset over its useful or service life in a rational and systematic manner. Okay, so essentially, as time goes on with the use of a durable asset, obviously you need to see that there is a value that's lessened from it on a yearly basis. Okay, so this is just going to be different ways to go about. Okay, that I'm going to explain shortly. So the cost allocation is designed to provide for the proper matching of expenses with revenues in accordance with the matching principle. So essentially what this means is that there's going to be a specific expense account that's associated with the specific asset that's being depreciated. Okay, so for example, if there's a building that you have as an asset, obviously you're going to have to match that up with an expense account. So chances are you'll see a amortization expense dash building account somewhere in your ledger. So during an asset's life, its usefulness may decline because of wear and tear or obsolescence. Okay, so essentially the value lessens from year to year. Recognition of amortization does not result in the accumulation of cash for the replacement of the asset. Okay, so essentially it just means that whatever value is lessened from the asset doesn't necessarily mean that you're getting cash back for that. Okay, that's pretty logical, pretty obvious. Land is the only capital asset that's not amortized. So talking way back from grade 11, okay, as I explained, land is usually one of the only assets that can gain in value. So for this purpose of the portion of the chapter, obviously we're not going to be using land because land rarely, if never, depreciates over time. So the factors in calculating amortization. So depending on the method that you use, these three factors are always going to be there. So first of all, the cost, which is all expenditures that are necessary to acquire the asset and make it for intended use. Okay, so just like last week's notes. So for example, land, if you have to do any improvements or any add-ons to the land, that should be included in the cost. Same thing for durable assets. Anything that needs to be done to the actual asset itself before its intended use should be included in the cost of that specific asset. The useful life is the estimation of the expected life based on need for repair, service life, and vulnerability to obsolescence. So depending on the nature of the asset, some last longer, some last shorter. Okay, so but that's usually given to you anyways. And the last factor is the salvage value, which is the estimated value of the asset at the end of its useful life. For example, if you have a car and the estimated life is 10 years, so at that 10-year mark, there should be an associated salvage value, meaning that you're going to get, no matter what, the minimum value for that specific asset if you get rid of it, sell it, dispose of it. Okay, so for example, if that specific car has a $500 salvage value, you should expect to get $500 for that specific asset at the end of its 10-year life. So talking about the methods themselves. So there's three of them that we focus on in this chapter. So the straight line, the units of activity, and the declining balance. Okay, so each method is acceptable under the GAAPs. So management will usually select a method that is appropriate for their company. Usually once a method is chosen, it should be applied consistently. So in other words, if you go with units of activity method for a certain asset, that specific method should be used over the useful life of that specific asset itself. Okay, you can't switch back and forth between straight line, units of activity, or decline and balance, just to, I guess, extend the life or the value of the asset. Okay, because once again, that's not seen to be ethical. So straight line method is of the three is the easiest by far in order to calculate. So when you use the straight line method, essentially what you're doing is you're taking the amortizable cost, which is the original cost minus the salvage value. And with that amortizable cost, you divide that by the lifespan of the actual asset itself. And then it'll give you an expense amount to deduct from that specific asset from year to year. Okay, so for example, if you have an asset that you purchased for $13,000 and you know that at the end of its useful life, it'll be worth 1,000. So the amortizable cost for that specific asset is 12,000. Okay, so if you know that it's going to last 5 years, you take the 12,000. Okay, so once again, cost minus salvage value divided by 5. And it essentially means that the amortization for each year for that specific asset will be $2,400. So at the end of year one, it goes down 2,400. Year two goes down 2,400. Year three, 2,400, so on and so forth until the fifth year. Okay, so at that fifth year, your asset is going to be worth $1,000. Okay, so essentially because you expected that asset to last 5 years, at the end of the fifth year, that's when you'll dispose of it. All right, so this is just another example with the straight line method. So as mentioned in the prior slide, the rate or the amortizable expense matched with that specific asset is going to be constant from year to year. Okay, so it doesn't really change. So yeah, with the declining balance method, so the calculation of the periodic amortization is based on declining net book value. Okay, so in other words, in this case, you're looking at the cost less the accumulated amortization of the asset. Okay, so usually the rate remains constant from year to year, but the value to which the rate is applied declines from each year. So essentially what the net book value is that however the asset is worth at the end of year one, that's going to be your beginning net book value for year two. Okay, so anyways, I'll explain with the use of this specific slide itself. Okay, so for example, let's say you have a $25,000 asset, okay, and the depreciation rate is 20%, meaning that for the example that we saw prior, because of the fact that it's going to last you 5 years, technically 20% is allocated each year, okay, because once again, you're dividing 100% by 5, which is 20%. But with the declining balance method, you always multiply that by 2. So you'll see that more of the expense to depreciation will be greater in the early years, and it'll lessen over time. Okay, so for this example, if you start off with 25,000 and you multiply that by 20% times 2, which is 40%, at the end of that specific year, it's going to go down $10,000. So you started off with 25,000. It's going to go down by 10,000, which means at the end of that specific year, your asset is now worth 25,000 minus 10,000, which is 15,000. Okay, so that 15,000 at the end of this year, for the next year, that's going to be your beginning balance to work with. Okay, so I just explained that. It's always going to be 40% from year to year. Okay, so that's going to remain consistent as well. All right, so with the declining balance method, as I explained, okay, so if you look at the curve here, okay, so it goes down a lot more in the early years, and it tends to flatten off as years go on. Okay, so it gets less and less in terms of amortizable expense as years go by. Okay. Okay, anyways, so with the units of activity method, this is probably the most specific method that you could use, because essentially you're calculating to a certain degree how much of that specific asset is being used, and depending on the use of the asset, that's how much the depreciation is going to affect the overall value of that item. So if you don't use it a lot one year, you'll see that depreciation will be a lot less than other years where there might be heavier use. Okay, so with this method, usually the total units of activity for the entire useful life are estimated. The amount is divided into amortizable cost to calculate the amortization cost per unit. And lastly, the amortization cost per unit is then applied to the units of activity during the year to calculate the annual amortization. Okay, so essentially what you're doing here is you're taking your amortizable cost, which is the original cost minus the salvage value. Okay, so just like the straight line method, divided by the total units of activity. So for example, if it's an automobile, chances are you're going to be using kilometers as your units of activity, okay, because when you drive a car, it's usually calculated in number of kilometers that it's being driven, and that's going to give you an amortizable cost per unit. Okay, with that cost per unit, you multiply that by the actual units that are used during the year, and that's going to give you your amortization expense. Okay. All right. So with that specific method, if you take the same example as the previous declining balance method example, if you take 25,000, which is the original cost of the actual item, minus the 2,000 of residual value. Okay, so in other words, at the end of the useful life, they're expecting $2,000 is going to be the value associated with the item, which means that your depreciable amount is 23,000. You take that 23,000, and they're estimating that they can get 200,000 kilometers out of the vehicle, okay, over its estimated life. So that means that 11.5 cents per kilometer or per unit is going to be attributed, okay, as your amortizable cost per unit. Okay, so for example, if you look here in step 3, if you drive the vehicle 30,000 kilometers in a given year, you multiply that by 11.5 cents, which means that for that specific year, 3,450 is going to be depreciated from the item itself. Okay, so once again, you want to focus on the amount of kilometers that are driven by the vehicle, and obviously, the more it's driven, the bigger your depreciation expense can be, and obviously, the lesser, obviously, it's going to be smaller here. Okay, so once again, it just depends from year to year how much is used in terms of the vehicle. Okay, so the little graph here on the right shows you that it varies from year to year because of the fact that some years have heavier use of the vehicle, whereas other years have lesser. Okay, so all right, so I explained that, and I explained that. Okay, so once again, with the units of activity method, it's always expressed in terms of total units of production or activity expected from the asset, and not based on the useful life of the asset. Okay, in terms of year. So you're not looking at time, you're looking at units. Okay. So expenditures during the useful life. So ordinary repairs are expenditures to maintain the operating efficiency and expected productive life of the capital asset. Okay, so as we saw in grade 11, there's always going to be expense accounts associated with the fact that there's always wear and tear of certain items. And if you look at an automobile, for example, you might have a gas and oil expense or maintenance expense. Okay, that's apart from depreciation. Okay, so don't forget that. So they'll be debited to repairs expense as incurred and are often referred to as operating expenditures, as we saw in previous chapters and in grade 11. Any additions or improvements are costs incurred to increase the operating efficiency, productive capacity, or expected useful life of the capital asset. Okay, so if you add on or if you improve the actual item itself, okay, so once again, you're not going to use specifically that asset as your account, okay, but there's going to be other expense accounts associated with that. Okay, so it's not because you improve your automobile by buying new tires that you're going to put the cost of those tires on the automobile. Okay, it'll go to different expense accounts for that. Expenditures are usually material in amount and occur infrequently during the period of ownership. Okay, so once again, it's not consistent. It happens here and there. And for the second item, so since additions and improvements increase the company's investment in productive facilities, they are debits to capital assets that are affected and are referred to as capital expenditures. Okay, so they're going to be in the assets section, but they're not going to be associated with that specific item itself. Okay, just under capital expenditures. If you need to dispose of a durable asset, there's different ways to go about. Okay, so the first one is retirement. Okay, so essentially you're just getting rid of it. Okay, not using it anymore. Okay, so you just assume that it's scrap. Okay, and it'll be probably pretty much disposed of. So for example, a car, you're gonna drive it over to the city dump or to a car dump. Okay, and that's when it'll be retired. You can always sell it. So if you can get money for it, okay, obviously that's always a better way to dispose of certain items because somebody can use it. Maybe you find that specific item is just has too much wear and tear and it's not being as effective as if you bought a new one. So you could sell it. Or the third would be through exchange. Okay, so exchanging one item for the other. So once again, that's another option in regards to disposing of certain capital assets. For natural resources, so some companies obviously deal with raw materials. okay, which would be known as natural resources. So this could consist of standing timber and underground deposits of either oil, gas, and minerals. Natural resources are frequently called wasting assets, which have two distinguishing characteristics. So first of all, they're usually physically extracted in operations. And secondly, they're replaceable only by act of nature, which means that if they don't regrow, so for example, a tree, okay, that's the only way that you're going to replace the timber is through time and through the fact that the tree is going to keep on growing. Okay, so any acquisition costs that are related to those natural resources is essentially the cash or cash equivalent price necessary to acquire the resources and to prepare for its intended use. Okay, so for example, if you look at the little diagram here on the right, okay, so that will associate itself with oil refinery. Okay, so if there are oil deposits or oil reserves that one finds, so for example, in Alberta, that would be the most obvious area in Canada that you could do so. So anything that you need to include, such as the refinery, would be included in that specific cost of oil minerals. Okay, so just like we did with land and certain durable assets, anything that needs to be added on for it to be able to be used has to be included in that specific item's cost of acquisition. Okay, so if the resource is already discovered, cost is the price paid for that specific property. All right. So with the units of activity method, this is usually used to calculate amortization and the restoration costs that are needed to the amortizable costs. If there are restoration costs, these are costs to restore the natural resource to a usable state, and a liability account is usually established for the restoration portion of the amortizable cost. Okay, we're not going to really see natural resources anyways, so this is just an FYI type of section of the Chapter 10 notes. Okay, so this would be an example of how you could calculate the amortization expense of a natural resource. Okay, so once again, it really relates to the units of activity method that I just explained. Okay, so that would be the one to use. Okay, but once again, we're not going to really be seeing this in this chapter, so it's not really that useful. Okay, this is just a presentation of how it would look like in the balance sheet. Okay, so for example, if you purchase a coal mine and that specific coal mine over a year went down by 384,000, it would mean that for that specific year, so in 2003, the net book value would be renewed at 4,616,000, which is the amount or the value that you have to work with for the next year. Okay, so every asset is presented like this on the balance sheet. As soon as there is some amortization that's related to it, you're always going to have a less accumulated amortization section for the asset that's being amortized. Okay, so I'm not talking about intangible assets because that's not going to be seen. So that's it. Thanks, guys.